I got something very, very interesting for you today. It's a tweet about the possible events that led up to the collapse of FTX. Hey guys, welcome to another video. This time we have a very, very interesting tweet from Mr. Jason Choi. So before we start, let's talk about Jason Choi's credentials. So he claims that he have met SBF before FTX started. So if you look in his profile on Twitter, let me move myself a little bit. If you look at his profile, he has pretty good credential about what he does. So he actually was under Forbes under 30, but at this point you don't want to credit Forbes for pretty much anything. They actually put SBF, the girl that started the diabetes blood testing company, she was also on the cover. So Forbes doesn't mean much anymore. But if you're going to his website, you can see more information about this guy. So he's a full-time crypto native investor. He was a general partner at Spartan Capital, one of Asia's first institutional crypto fund, co-led investment of 80 companies, helped scale from 9 million to 500 million. As head of research, he led his team to deliver the #1 return emerging fund in 2020 and #1 return hedge fund in 2021. So this guy knows what he's doing. Well, this doesn't mean much anymore after crypto, but he has the track record of getting good return. And he's the head of research. So I'm going to give him the benefit of the doubt, and he's a pretty good investor or researcher. Anyway, the point of this is to look into what he's saying here on this Twitter thread. This is the thread about FTX and the events that led up to it. And he's collected all the information from the web and from the rumors of the Twitter sphere. But let's see what the interesting information he's going to show us. So first, he claims that he met SBF before FTX started and witnessed their rise and fall. I can't stand New York Times puff piece. That's another story. Apparently New York Times and a lot of other publications are in bed with SBF because SBF contributed a lot of money to their war chest. So they don't write too many harsh pieces on SBF. So this is a piece that's going to be raw, it's going to be information, and it's going to be the take from Mr. Choi here. So if anyone wants to know what happened, send them this. So basically, let's go into it. The story of Alameda and FTX can best summarized by SBF's philosophy of betting big. Every major decision they have made is related to acquiring more leverage via deceptive fundraisers, financial engineering, and ultimately outright fraud, as we will see below. So SBF is known for being this idea of trying to get as much money as possible and then try to give them all away. But people are calling him out for trying to use that idea as a cover for what he's doing, for all of these deceptive practices that he's been doing. So in November 2018, January 2019, a small hedge fund called Alameda Research was raising debts from investors, promising high return with no risk. Now, I did a video before this. You can check out in the video the actual pitch deck from Alameda at that time, 2018, 2019, when they were trying to raise money. And one of the highest highlights was that a high return with no risk. So I said it in that video is that whenever you see high return with no risk, that's a red flag and you should run away. Apparently, a lot of big funds don't think that way. And let's go on. So that's 0, that's 1. I really hate Twitter threads. They just gotta make it better. Anyway. Oh, he deleted a tweet. I don't know which tweet was deleted, but apparently part 2 was deleted. Later that year, FTX planned to launch for January 2019 and close an 8 million seed fund for several funds, announced in August 2019. One investor memo, Alameda FTX is cited as a risk, as well as concern about SBF's personal split commitment between the two. So some investors already noted that SBF is actually the head of FTX and Alameda. So when you split between two companies, you don't have the attention of the full attention of each company. So therefore, that's cited as a risk. But that's, also they laid out that trading in their own exchanges is a risk. An exchange needs a market maker to get it off the ground, and Alameda will be the initial market maker for FTX itself. So Sam's company, Alameda, will be the market maker for FTX at that point in time. The teams intend to bring in more market makers over time. However, this is a major risk. We have talked to other quantitative hedge funds who are hesitant to trade on FTX for this reason. Yep, you kind of don't want to trade on FTX because Sam actually owns the market maker there. So they will always have the insider information, more information about the trades ahead of other market makers. So you probably don't want to be a market maker on FTX, given that Alameda is the market maker. So keep going. From my primary sources, who will remain undisclosed, FTX was allegedly started as an easy way to access capital by Alameda due to difficulties in raising for the latter. This is unprovable short of leaking internal chats, so we'll leave it for the courts. Wow, so apparently Alameda was started FTX was started as an easy way for Alameda to gain capital. In the early days, Alameda being heavy portion of FTX's volume was an open secret. An employee told me that Alameda has an exclusive API key that followed faster access than any user, offering systematic way to profit off clients. So Alameda, the market maker, has an exclusive way of getting faster trades or better trades and profit off clients. This is this is similar to how Robinhood makes its money by front running their own clients. So here's a message he sent to a FTX investor. So this is 2019, right? Jason Choi sent a message here. He did some number crunching and the volume doesn't check out. OKX volume is inflated. OKX is another exchange. Huobi volume also after they climb down. But FTX volume seems very high. Even if we apply BitMEX's average leverage, AX, as discounted as the end result higher than reported volume, which means that their principal market maker, Alameda, may be doing a ton of volumes. So again, Alameda is doing a ton of volume because they have this special access to FTX. So around September 2019, Alameda allegedly attempted to manipulate futures on Binance, which was thwarted by the latter. However, this would likely mark the beginning of the bad blood between Binance and FTX. So here's CZ, a tweet from 2019. So a market maker from a future exchange tried to attack Binance future platform. No one was liquidated as we use index price, not future prices, for liquidations. Only the attacker lost a bunch of money, and that was that. So CZ probably knows that it was Alameda's doing, but he didn't want to name them in public. And Alameda was trying to manipulate the futures market. But Binance was using index prices instead of liquidation prices. So in the end, nobody was liquidated. Nobody but the attacker themselves. Because it costs money to create an attack like that. As FTX continued to grow, its appetite for capital seems insatiable. In the midst of so-called DeFi summer, which that was like a year or two ago when we were doing the Wonderland videos, FTX capitalized on the FTX hype by creating Project Serum, a decentralized exchange on Solana. So capital was very, very abundant during DeFi summer, and FTX capitalized on that by creating this exchange called Project Serum on Solana. And that's why they are so invested in the Solana platform. The raise was conducted in a way to encourage speed, not diligence. The faster investor committed, the lower the price. This is another red flag. Whenever you see a project like that, say, hey, if you are one of the first X number of people who go in here into this project, you will go in at a good price. So that's a screenshot from Project Serum. You get good fill when you are in early, but as you go further down, you will have to pay more to get in. So that's trying to create this artificial demand or FOMO in order to get money into the system. After FTX became directly involved in multiple Serum Solana ecosystems, such as all of these, all launched tokens for a short expanse of time. A full thread SBF shilling all these crap coins. So these are shit coins that are launched by FTX, and then SBF is launching, he's touting these things as the next PayPal pretty much, and in order to try to get people to invest in it. So they show their own shitcoin that they already invested in. According to my sources, much of Serum was operated full-time by FTX employees. Some Serum ecosystem projects were made seen as third-party projects, but were actually in fact internally operated. So there's the practice of deception. So why did FTX do this? Well, first, some context. Assuming Alameda and FTX were much closer than they represented, something changed internally within Alameda around that time. So here's Sam. That's a guy who used to work for SBF and FTX. He's pretty high up there. So he's calling out something. This is 2021. So he's calling out 2 years ago, which is 2019. Alameda maintained a pretty strict delta neutral most of the time. So this means they were market makers. So they don't have a long position and they don't have a short position. They want to maintain a neutral position most of the time. And being a market maker, that's how you make money. You make money capitalizing on the small price differences. So they try not to be directional. Generally try to quite hard to make sure that our P&L was from spread by ARBs. Today, not so much. We got really long in winter 2020, for instance. What changed? So this is a thread about what exactly changed. They actually got on the long side. This is during DeFi's 2020 DeFi summer, where the price of everything pretty much went up like crazy. Of course, that's why they went long. Namely, Alameda moved away from delta neutral strategies as their edge eroded and began to assume a massive directional risk in crypto. They did so a massive amount on leverage as well. So not only did they went long on something, they took out huge leverage to went long on the directional bets. So how does the Serum asset fit in? They were likely used as collateral to enable for aforementioned leverage. All trade at thin circulation. It's easy to manipulate an artificial price for them to use to pad balance sheets. So they try to use Serum, the shitcoin that they invest in, as a collateral to borrow more money for their main play. Of course, how do they do it? Well, they own the shitcoin and they can fake the price of shitcoin. That's why you got to be careful when you invest in shitcoins. Let's say Alameda funds a semi-incubated project at $10 million, fully diluted valuation, with $2 million. FTX then lists the token on its own exchange, but only release 1% of the total tokens to the market. As the market are thin, Alameda can prop up prices using few millions dollars to create a fake fully diluted value of say $1 billion. Suddenly, your $2 million is now $200 million on paper. This is an open secret of what the industry insiders call SAM coins. Noted the circulation of price. So all of these coins, FTX pretty much listed on their own exchanges and only release a small amount of supply. And with that small amount of supply, they can easily, because of the low number of liquidity in those coins, they can easily prop up those values by buying those shitcoins. When they do that, the price of these things can go up like 100% in a day, very easily. And then all of a sudden, when the price of these shitcoins go up, you actually have, they are now worth a lot more than they claim all of a sudden, or instantly. And that's how you propped up shitcoin. This is a common strategy a lot of shitcoin creators use in DeFi to prop up their valuation. And then when they have this much valuation, they can use that as collateral to borrow more money. And that's how they were able to get money and highly leverage themselves to do it. And that's what this is saying here, to fund their directional bets. So a lot of people, insiders, question the legitimacy of these schemes, were personally bullied and threatened by SBF into silence. So this is how he runs the company. If you question anything like that, you will get silence. And this creates hundreds of millions of dollars for Alameda and FTX, based on this fake valuation. And I have a feeling a lot of crypto shitcoins are doing it the same way. So it's still dwarfed by its FTT holding. So Alameda actually holds a ton of FTT token, which is a native token that they create. And they can easily pump up if they want to. Some of the sharing coins and FTT itself were pledged on FTX official the only exchange to allow such asset to be used. So no other exchange wants to take on these shitcoins except for FTX. It's likely that Alameda incurred billion-dollar hole. Alameda pledging illiquid collateral to borrow money to finance bets. That's a good summary of what exactly happened, which gets margin called as market went down this year, leading to the theft of FTX users' funds to put out the fires. So that's a pretty good, well, at this point, all of this are speculation, but I think it's a pretty good explanation. So when you use these shitcoins as collateral to leverage your bets, we know what happened this year. This year, 2022, at the beginning of the year, all the shitcoins went down. All the coins went down. Everything in crypto here in the crypto market, it collapsed. All the shitcoins went down as much as 90%. So all of those shitcoins that Sam touted, the Sam's coins, all of these things, pretty much went to zero. So when they went to zero, remember, they were used as collateral for their leverage. So when that happened, when the price of these things go down, the people that you borrow money from is going to ask you to repay the loan. But the value of these things are nothing now. And FTX has no money to pay the loan. So what do? They use the users' funds to pay back the loans. But even those is not enough to pay them back. And that's how you get the implosion of FTX. So the liquid reserve of FTX is lower than the amount of user deposits, but chances are this hole was manageable. But this all due to Sam just use users' funds in order to pay back the money that they borrowed. And that is how the collapse of FTX happened. The words were going around. Somebody probably leaked it out to CZ, and CZ realized that the FTX that they were holding was BS, and they wanted to make say in public they want to unload their FTX token, and this causes even more collapse inside of FTX, because keep in mind that FTX actually holds a ton of FTT tokens. So if CZ started to sell their holding of FTT token, it's going to cause a huge price drop on that. And famously, the Caroline mentioned that, hey CZ, instead of selling it to the market and have a price impact, you should sell it to us for $22 each. But CZ refused, and that's what the final straw in this whole thing. And it caused the collapse of FTT as bank runs started to happen. And that is a story of how FTTs collapse. So I hope you guys find this thread interesting. I will link it in the description below. Take your time to read about it. Take your time to try to understand what exactly led to the collapse of FTX. So with that said, I hope you guys learned something from this video, and I hope you guys keep it in there for all the latest updates on FTX and SBF drama, and I will keep it updated for you. Thanks for watching. I hope to see you guys in the next video.